While trading the boom and crash indices is a great way to grow a small equity account, the risk associated is also huge. The market can sometimes give you nightmares, especially if it's in the opposite trend. Here are my tips for trading the boom and crash indices successfully. I have been trading the boom and crash indices for over a year now and have learned some useful tips that I want to share with you today. I have learned these tips the hard way so you don't have to. Here is the list of my top 7 tips for trading the boom and crash indices. Place your stop loss wisely. Ideally, you should consider the following 3 things before placing your stop loss. Spread. Difference between the buy, offer, and sell, bid, prices quoted for an asset. For instance, if you have shorted, sold, an asset and the exact stop loss point is 10,300, you should consider spread while putting a stop loss. A wise stop loss, in this case, would be 10,299.500 or even better, 10,299. Stop loss hunting is real. Stops are put right below, above support and resistance levels or demand and supply zones. Sometimes, the market breaks in fiercely just to hunt stop losses to kick out risk-averse traders and reward the brave ones. Put your stop loss at a distance from your level or better, and wait for the perfect entry point to avoid being the victim. Risk-reward ratio. Think about this. If you are trading for a spike with a standard lot size of 1 and the average spike is 15 pips, then you shouldn't risk more than 7.5 points, risk 50% of your reward. However, if you're planning to trade a longer time frame, which could potentially earn you some 100 to 200 pips, then it's okay to risk 50 to 100 points. Bottom line. Set your stop loss as per your expected reward. No chart, no trade. Creating and analyzing charts on a daily basis is a daunting task but worth it. Before you start your trading session, make sure you fully understand the bigger and clearer picture of the pair. That means, draw your support and resistance levels, demand, and supply zones, find different patterns and trends in different time frames, use your favorite indicators, have a cup of coffee and you are good to go. Don't just trade for spikes. Like any other forex trading pair, boom and crash indices follow a technical pattern and respect the rules of price action. Therefore, try to go for longer trades instead of focusing on the thrill of spikes. Your last position could have easily earned you 200 pips, should you hold it. Know when to go big with boom and crash. The amazing thing about boom and crash is that the spikes can be predicted with darn good accuracy. Your prediction could be based on support and resistance levels, demand and supply zones, simple or exponential moving averages, or any of your favorite indicators. Sometimes, you can catch a spike with stop loss as close as 1 or 2 pips. That being said, you should use maximum lot size on trades with high probability and tight stop loss. Time to take a break from boom and crash. The boom and crash indices are based on a lucrative concept and are addictive. Once you start trading them, you just cannot hold your breath to catch another spike. While the market may respect your strategy most of the time, it gets stubborn at times, and that's when you should take a break instead of attempting to recover your losses. If it's not following your strategy on a certain day, it isn't worth trying. In the meantime, you can check out the position of other pairs like volatility indices, jump indices, and step indices. Or even better, give yourself a treat and wait for the market to create liquidity and kick out the impatient ones. The market isn't going anywhere. This one is extremely important. Don't take a trade just because you have to. Spikes occur on a regular basis since the inception of the boom and crash market. If you miss one, there are hundreds more to catch, so you need not worry. Sometimes, the fear of missing out on spikes or the regret of long beautiful spikes affect your entry points, thus resulting in severe losses. While it is more of a psychological issue, it adversely affects your decisions and you should learn to keep calm no matter what. To conclude, follow your strategy and don't let your emotions or the tricky market seven you out. Don't let the reds scare you. The thing with boom and crash indices is that when you are trading for spikes, the trade starts in loss and the loss continues to grow with each M1 candle. Watching that gradual reduction in your equity can be disturbing, especially when your position size is big, and sometimes you may close your positions in panic or place your stop loss too close to avoid further losses. Now let's think about it for a minute. While the loss keeps adding up slowly, the spike can make all the reds blue in the span of a second. I have had instances where my positions would be in $300 plus loss in the next minute. That same trade setup would give me double the profit. In order to make money in the market, stay patient and brave. However, do not take unnecessary risks. Best of luck with your next trading session and don't forget to subscribe to our channel.